You can keep
I
your
can
camera
switch
on,
on?
Ritika.
Okay, sure. All
Yeah,
right.
yeah.
Okay.
You okay.
Okay.
Yeah. Yeah. So hello friends. Very good evening, one and all present here on this platform. So, yes, I'm glad to see the good participation coming in. And thank you for coming for such a short notice. So, we have a very wonderful guest with us today, Ritika Behra, who is a Vice President Equities with Bandhan AMC Limited. So, I would like to give you a brief introduction about the Ritika. So, Ms. Ritika Behra has nearly a decade and a half of experience tracking the Indian equities market. She's focused on fundamental research covering stocks in the BFSI space. Before joining Bandhan AMC, Behra was the VP Investment at Ocean Dial Asset Management. Prior to that, she was the lead diversified financial at Elara Securities Private Limited. Earlier, she has also worked at Batliwala and Karani Securities Private Limited, Morgan Stanley Advantage Services and CRISIL. Ms. Behra has completed her MBA from ICFAI Business School, IBS, Hyderabad, and her Bachelor of Accountancy and Finance from the University of Kolkata. So I would like to give you a warm welcome to this platform, Ritika, and thank you for sparing your time for today's evening. Thank you, and over to you. Thanks, Ritika.
Thank Thank you so much, Disha and team. Uh, Thank you to everyone who's watching us today, and thank you for taking out time to listening into the presentation. As Disha was mentioning, we are here to actually make a special presentation to all who are watching us today. So this is the launch call for Bandhan Business Cycle Fund. As you can see, we are actually launching this on the 10th of September. And this is what the objective of today's presentation is. How I've structured the presentation is that I'll take you through three parts of the presentation. One is to explain as to, what do we mean by a business cycle? And this is important because while the terminology might be familiar to most of the people, it's just that how are we also looking at the business cycle is important. Number two, I would like to explain to you that why to actually invest in a business cycle fund. And the third part of the presentation would be why Bandhan Business Cycle Fund. So just the first piece now, which is what is business cycle? Uh, as you can see on the screen, so the economy actually goes through four phases. And these four phases actually define which cycle are we in at any point in time. And these, while it's at a point in time, but cycles are usually much longer. But broadly, the four phases in a cycle are the expansion phase, the peak phase, the contraction, and slump. So expansion phase, as you can see, maybe if at all the how the graph is actually starting from a point and it's improving, it's actually coming off from a low point, and that's where expansion is the first point where maybe you can say is once the economy has started to recover, maybe because the background of the economy would have been that we wouldn't have been doing as well before that. So in the improving phase, what happens is that businesses again look to thrive, or rather are thriving, incomes are rising. As you can see on the presentation, we are mentioning the same, and the consumer spending increases. So this is the initial phase of the recovery of the economy, which probably is on the backdrop of maybe they would have seen a back time in the previous phase. Gradually this positivity actually reaches the peak, and by peak I mean actually the economy reaches a point wherein businesses are operating at their peak capacity, consumer spending has been enough. Maybe say for an example, we would have bought enough clothes or enough automobile, etc. The demand also probably seems to be peaking out across. That's where actually the economy reaches maybe the full potential and the peak. From a peak, as you obviously know, we obviously have the law of averages prevailing, and from the peak, generally the economy actually looks to maybe go back to the average, and that's where actually the contraction sets in. So that's the sort of the slowdown phase in the economy. When the slowdown actually extends even further, that is actually the business earnings are declining, the consumer spending has reduced to a considerable level, that's where actually the slump kicks in. And that's the end point of the cycle. And that's when, again, you see the curve actually moving up because, again, law of averages on maybe the cycles again get to go back. And we are again starting from the earnings expansion side of the economy. So these are the four phases of the economy, which are broadly the definition of a business cycle. So like I said, each phase influences the economic growth because in the expansion and in the peak phase of the economy, there are certain opportunities or certain sectors which are doing much better than the others. And that's the difference that I want to draw your attention to. It's not always that just because the expansion and the peak means that, the economy is doing very well, would all the sectors be doing equally well? There would be certain differences in the earnings potential, in the demand, in the business outlook, in the business capacity, even in an expansion and a peak cycle for different sectors. And similarly, in a contraction and a slump also, that doesn't mean that all the businesses are going through a bad phase. There would be certain sectors which would still be doing well in a contraction and a slump phase, and there would be certain who would not. So the idea behind a business cycle and or a business cycle investing is that we look to actually make a strategy wherein we understand where are we in the current phase of the economy, and irrespective of the phase of the economy, which whether be it expansion, peak, contraction, or slump, we look to understand which sectors are going to do well and try to avoid the sectors which are not expected to do well. Because as I just explained that it does not mean that if a contraction or a slump is there, there wouldn't be any particular sector who would not be doing well. So the idea of business cycle investing is that after understanding the cycle where we are, the next step is to understand the sectors that are going to do well in that cycle. And another important third step is to avoid the sectors which are not going to do well. Once we have understood the phase and the sector, the final the selection is obviously the stock selection. And that's how the business cycle strategy looks to create alpha. And obviously, I'm going to explain more and more of this in most of the other slides. So just the second slide is to explain to you how are we seeing these cycles specifically in the context of India. As you can see on on your screens, the red line is actually the India GDP growth rate. The dotted lines are actually the long-term growth rate of the economy, which is a 6.6% number. So how we are defining actually the expansion and the contractionary phase of the economy is that wherever in the phases that you actually see are green in color, these are the phases actually wherein we have grown above our long-term average growth rate, and we call them or categorize them as the expansion phase. The segments wherein they have grown below the long-term average growth rate, we have actually categorized them as the contractionary phase of the economy. This period is actually being colored yellow because this was the COVID period, so quite of a bit of a volatility in the numbers because we actually came from a very bad phase previously. That's why we have not really sort of categorized it, but otherwise this was also a expansionary phase of the economy because we came out from a very 2 quarters of a decline. So that's how we look at the expansion and the contraction phase in the Indian economy. Looking at the GDP projections, which stand at about 7.2% and a 6.9% and long-term growth rate of a 6.6%, we see that we are still continuing to be in an expansionary phase. Secondly, is that how are we connecting actually the macro to the market? So this is the slide which will actually help you understand how is actually the various phases of the economy influence the market cycle. Because it's important because eventually the idea is to maybe once understood the macro to make the investment decision. So as you see on the left-hand side of the chart of the presentation, the price to earnings and the EPS growth are not a linear line. They actually also pretty much move up and down in cycles. Now, this is again, obviously, because of the macro cycle. Otherwise, this would have been a linear upward or a linear downward trend. Similarly, if you see the Nifty 500, which is also the benchmark for our business cycle fund, and that's why we have chosen that to show how has that performed. Again, this has not really performed in a linear phase because again, the macro has various phases. Every sector in turn have their own cycles, and that's how the combination of both is where you see the returns obviously having more performed on a cyclical manner. So that's the first part of the presentation where the objective was to make you understand what is a business cycle and how we see a business cycle. The second part of the presentation is to explain as to why choose a business cycle fund. So if you recall the first slide, or rather the first slide that I had actually shown, wherein we had defined the business cycle as there are 4 phases in an economy. So this is a more of a illustrative, because at times some sectors, despite being going by the rule book, should have performed in a particular phase, tend to actually have a lead or a lag kind of a connection in terms of the stock price movement. But going there a little theoretically, if ideally we are in an expansionary phase, and I would like you to concentrate here on these green parameters, which are economic activity, credit growth, capacity utilization, capex, etc. And there are many more actually, but just for the ease of presentation, we have used a limited some 7 points here. So what we are saying is that in an expansion or a peak or a contraction or a slump phase of the economy, these various parameters actually behave differently. See, if we take a case in point in an expansionary scenario, ideally, suppose just to give an example, like I was giving the very recent example of COVID. So we actually came the 2 quarters of bad GDP outcome, and now obviously we were in a lockdown. We couldn't do much in terms of maybe then that's why the economic activity declined. Once the economy started to pick up, so there was a rebound in economic activity. Credit growth gradually started to pick up. That's the second parameter that I'm referring to. Your capacity utilization again started to improve, because actually the companies wherein, maybe in case of COVID, maybe immediately it was not the capacity utilization because people were sitting with inventory. But usually if the demand had actually in the previous phase really come off sharply, gradually companies also then reduce their production, and that's why the capacity utilization looks to pick up. Even in COVID, actually, which we saw that initially because of the fear that how would the demand pan out and etc., it was actually the government which was actually doing most of the heavy lifting to pick up the economy. Private capex was not so much visible, which is the fourth point that I am referring to, the rise in government capex. Interest rates were still low because again economy was coming from a bad phase, and that's the time when we generally the monetary policy is actually quite accommodative. Corporate earnings start to improve because they had seen a bad phase, and unemployment gradually is declining. So this was just one example of a particular phase and how the various parameters that are mentioned in the highlighted in the green color actually performed. If that was the case, theoretically, the sectors which actually look to perform in that phase are your financials, consumer discretionary, real estate, metals. In fact, intuitively, if most of us think that did these sectors actually perform in the example that I gave, they actually did. So obviously, once we had saved enough, either we were putting the money into bank deposits, or we have seen the equity market really moving up because a lot of money came into direct equity or mutual funds. Consumer discretionary, I mean like auto and QSR and retail and jewelry, etc. So that obviously in the example I gave, that in that example it immediately didn't pick up, but generally consumer discretionary as a segment generally picks up when positivity or the economy is rebounding. Again, generally in a expansionary phase, the sectors that don't do well are your IT, consumer staples, pharma. And just, I also want you to have a look at this particular dichotomy. Actually, if you recall that I had said that certain sectors do well in an expansionary and peak and certain don't. And then vice versa. So, if you see pretty much the sectors who are not doing so well in an expansionary and a peak scenario are actually doing better in a contraction, in a slump. So the idea of this slide is to say, while the stock performance can be a little deviating because of the lead and a lag, in the earnings projections or the earnings outcome. But generally, even in an expansion and in a peak, you have certain positive sectors, and in a contraction and a slump, also you have positive sectors. So the idea of business cycle investing is to, like I had just to reiterate the point, to be able to pick the sectors which are going to work in the expansion and a peak phase, and to avoid the ones which are not going to work in a particular phase. So this slide is to explain, and I would urge you to read this more on a vertical way. So like maybe see the performance in CY10 and not rather across the slide. And why so? Because if you actually see for most of the years, as the heading that we have tried to keep actually, that the winners and losers are not same in every cycle. So if you actually see if at all there is a sector which was actually green in a particular year, it need not necessarily be green in the second year. Now the green color means that that sector has actually, in terms of the performance, it has actually beaten the benchmark. And the benchmark here is Nifty 500. And also, so what are we trying to say with the help of this slide? That every year you'll see there are a minimum of 3 to 4 sectors in the positive zone, 3 to 4 sectors in the negative zone. And again, that's the reason why we look to see, or rather invest in a business cycle fund, because the idea of a business cycle fund is to not choose one sector or one theme. The idea is to choose those sectors which are going to do well in a particular phase. And like I said, to avoid, even if you're avoiding a sector which is not going to do well in a particular phase, you are actually going to generate a significant alpha. So say just maybe because we are on this page, if I were to maybe say give an example, if we were in CY16, if the market returns were actually quite soft, but even if I were had the the judgment of maybe putting in money aggressively in an energy sector or in a commodity sector and in metals, and actually maybe if I would have avoided maybe IT and an infra, even by actually in a year like a dull year, we could have maybe actually generated good returns just by the sheer overweight or the underweight in the sectors which are actually going to do better in a particular phase. So the next few slides, or rather the next 3 slides, just want to take you through certain examples to maybe try to get the story out a little more clearly. So maybe if you see, the first example is the infrastructure sector. So if you notice this blue line, which is the center capex, a pretty much a flattish kind of a trend. And if at all, we believe that this is not going to really pick up, and we didn't believe in the promises which the governments actually were making, that that the infrastructure which is a need of the hour, even still it is a need of the hour. But even back then, if at all, we didn't believe that this number is actually going to reach from a 4.5 trillion to an 11 trillion, we would have completely missed this rally. So actually, if you see the index level at September 20 to June 24, it's pretty much tripled. So the idea here is that if you see, this particular phase of the economy was also the expansionary phase. And here we obviously looked at which macro indicator which we actually looked at was the government capex. And if at all one would have been right in picking up the right macro and in turn the sector, the returns could have been much higher. So that's one example of infrastructure sector. And if you obviously see that, the expectation are that, the capex would actually still continue to grow from an 11 trillion to maybe about a 20 trillion kind of a number, even going ahead. Coming to a sector which is, very close to everyone's heart. I mean, we all keep thinking when to buy, and everybody's dream is to buy a house. So actually, this phase is again, a phase wherein the economy was doing fine. This particularly so because we actually, like I was giving an example at the start also, we came out from a bad phase, and that time, we all were in a lockdown phase, and some of us would have faced the problem that, especially in Bombay, because the houses are actually quite small there, that we look to improve our lifestyle, and we look to actually buy new houses back then. The trend though still continuing. So it was a trend wherein actually the sales which you see are the blue line here were actually much better than the new launches. So what I'm trying to say that the trend in the developers were actually able to first sell the unsold inventory, which was actually maybe having built up in the previous cycle. And that was also, so the sales from those inventory were picking up. And secondly, even the positivity in the economy meant that they actually could with that sale money, they could actually launch newer products or launch newer projects rather. And that actually corroborates with the return of the sector. Again, a pretty much a 3 to 4 time kind, 3 time kind of a return on the sector. So here also we did the same thing. This example, if at all we were sitting there and we had the prudence to understand the phase of the economy, the macro which will actually do well, eventually the sector which will do well, and finally the return on the sector would, or rather the return on the fund could have been much sharper, because if we would have selected the right sector. Now, this slide is to maybe give you in a one stop for all the for the slide which I had explained, that the four phases of the economy and which parameter behaves in which direction, and basis that direction which sectors work and which don't. So if you actually see this particular slide, we actually had said that the auto sector, which is a discretionary sector, and we had clubbed it in consumer discretionary. We said that the auto sector usually works well in a expansionary phase. So we have actually picked an expansionary phase of the economy. And just to highlight to you, the yellow line, which is the Nifty Auto Index, is above the blue line, which is the Nifty 500. So the idea is to say that the auto sector has outperformed in an expansionary phase. Generally, the IT sector and the pharma sector are clubbed in the defensive zones, and they tend to do better in a contractionary phase. So that's what we are trying to show here, that we've picked up a contractionary phase of the economy, wherein actually the IT sector, which is like this purple color line on Nifty IT, and the Nifty 500 is the line below. This is the time when they actually made a very significant outperformance. And very similarly, a pharma example wherein we've shown when actually the phase of the economy turned, actually maybe uh, the sector return also tilted from being actually a positive territory because the phase changed, and that's how the sector rotation happened, and eventually maybe the returns didn't really work so much for the sector. So that's just to tell you that how maybe various sectors have performed in the previous phases or in the past. So now the most important part of our presentation, like I said, we are launching the fund on the 10th of September. And having understood what is a business cycle and why should we invest in a business cycle fund, just to maybe sum up at this point in time, like I said, a business cycle obviously has four phases rather. Every phase gives an opportunity to choose the correct sector. Having chosen the right sector, if you have the conviction in a particular sector and you would have put in a very significant or active share in that particular sector and even avoided the sectors which are expected not to do so well, you would have generated a significant alpha for the fund. And this obviously is a much balanced approach because you're not playing one particular sector here. You're actually buying 2 to 3 sectors which are expected to do well, and avoiding, obviously, like I said, maybe 2 to 3 sectors which are not expected to do as well. So another important point is that this is a very active rotation strategy. So obviously the idea is that once the cycle of the particular sector has been played out, the fund manager is expected to actually rotate out from the sector which has done well to maybe a sector which is expected to do well in the future. So actually the risk of rotating out of a sector is actually taken care by the fund. So the idea behind business cycle investing is that it's the sectoral call is the most important. The second comes your stock selection, and it's being an active strategy. The idea is to be in the sectors which are doing good as in the medium term, and rotate out of this and rotate into the sectors after the story has played up to the sectors which are actually expected to do well in the next phase. And now, obviously, just to after the recap, just to maybe take you to the most important part of the presentation, wherein why Bandhan Business Cycle Fund. So what are we promising here? So firstly, it's a 360-degree approach. There are three core principles for us when we look to maybe deploy this strategy. Now, the first important principle is the economic cycle. So like I said, and the reason why I took you through that initial basic discussion is that our approach is to a little true to the how a business cycle strategy should be, wherein we are looking to understand the phase of the economy that we are in. And how do we look to do that? Because of the certain parameters which are available, maybe on a longer term basis, or maybe certain on a very frequent basis, could be a monthly data, could be a quarterly data. So we would look to actually analyze some 40 plus parameters here, which are actually available on a frequent basis. Now, these parameters are obviously known to us, but obviously the idea is to maybe trying to understand more just by looking at the data. So what are these parameters? These are the GDP growth rate, the interest rate, inflation, the currency, the export and import data, then your IIP, PMI, and we can obviously go along because it's a 40 plus set of data which we look to analyze to make our judgment on this with the phase of the economy. Obviously, there is a simplistic answer on the GDP, which I had given you in the initial bit, that we are in an expansion or a contraction zone, and a simplistic approach to understand that. But beyond that also, because it's not just about understanding are we just in an expansion or contraction, but these parameters obviously are important because it also makes us understand that even within the particular phase that we have chosen, which point maybe are we in the mid or in the early or in the late, and these parameters obviously try to help us arrive at that to the best of our judgment. Having understood the first point, which is the economic cycle, we will move to the second bit, which is your equity market cycle. So obviously valuations are extremely important to track, and that's what we look to do here. But in addition to the valuations, we actually look to see the aggregate earnings, the sentiment in the markets, because they have a very strong bearing on the flows. And by flows, obviously, I mean the flows from the either from the retails or from the institutionals, which could be the FIIs and the DIIs, and also try to maybe then make a more informed approach to looking at valuations rather than looking at valuations on a isolation. So having done the economic bit, second is your equity market bit, and the third one is the sector cycle bit. So obviously, it's the idea is to, once you've understood the first 2 point, or rather we have understood the first 2 point, we want to maybe use this to understand which sector is going to do well. Now here are obviously sector specific drivers, and the usual ones, but obviously important ones, which are your where is the demand and the supply in economic demand and supply equation at the moment for the sector, because that obviously is a very important to understand the growth in the sector. Your profitability, which are your margins, be it could be your NIM for a bank and a EBITDA for a non-financial. Where is the capex coming into? How is the maybe even the debt on the books? How are the leverage levels? And eventually, having understood this, that whether the PNL is strong enough or not in terms of the growth prospects, whether the balance sheet is strong enough or not to actually take care of the growth expected in the future, the eventual answer is to obviously do a bottom up. So it is a top-down strategy to start off with, and that I'll come to the next slide. But just to maybe wrap up here, it's a three-principle approach to understand the economic cycle, the equity market cycle, and eventually the sector cycle. But it is obviously a bottom-up eventually at heart, because stock selection is the key to outperformance. So as you see in this slide, the first part is to do a sector selection, which is the top-down approach. Having understood which sectors are going to do fine, the second bit tells you that it is a stock selection or a bottom-up strategy. So it's a combination of a top-down and a bottom-up. In a top-down, the principles pretty much remains the same across any scheme, but I would still obviously look to share with you. For us, obviously, management quality is paramount. We do not want to be, we are okay, maybe just for illustratively, okay, paying a little expensive valuation for something, but we don't want to pay anything just because it is cheap, but we have to actually has to look beyond it, because there might be certain concerns around maybe, say, primarily, maybe a management issue. So the approach is that we are very conscious of management quality to start with. Company fundamentals are equally, or maybe I would say, I don't know more, but equally important. Herein, like I was just explaining in the previous slide, we look at the having understood the sector. If at all we are positive on them, obviously the next drill down would be which are the companies which are allied to the growth of the sector, and whether they would be outperforming or not on the growth, and secondly on the margins, whether the individual company's balance sheet is good enough to maybe take the growth forward. Is the working capital, etc. So these are the broad return ratios, or maybe the broad P&L and balance sheet parameters that we will look to maybe understand. And finally would come valuations. We have to be careful of valuations at any point in time, maybe a little more at this current phase, but valuations are always important, because it should be the right, it should not be just for any price, but it should be for a right price to maybe for a better alpha creation. So once the top down is in place, further you've married it with the bottom up, and finally it makes a entry into our portfolio. This is just to maybe how I started that, why you should be looking at a Bandhan Business Cycle Fund, because of the approach or the 360-degree approach that we have taken, wherein we look to do the understand the economic cycle, followed by the market cycle, and eventually the sector cycle. This is just the first illustration of the macro cycle. So like I had shared that we would be looking at more than 40 indicators. Obviously on your slide, it's a little less than 40 just for present representation purpose. So obviously these are a lot of parameters which are, certain are to be seen maybe on a monthly basis to maybe make a sense about the changing course of the economy. Some are very long-term trends which are like GDP. Certain are like, maybe not so monthly, but maybe even on a quarterly basis give you a lot of sense. Maybe the credit growth, again, maybe going back to a little more higher frequency data, the GST number, the PMI, the IIP numbers, which actually obviously come on a more frequent basis. So the idea is obviously trying to make the best use of the data which is available to us to understand the first principle, which is where are we in the economy. Coming to this slide, and if you recall, I was saying in the second part of my 360-degree approach that evaluations are extremely important, but can we look at evaluations with another lens? And this is that slide that I just want to maybe share to say that uh, uh, we obviously have to look at how valuations are at the moment for say like for the overall indices or maybe for individual stocks and sectors. But maybe it has to be seen in the context of how India stands versus maybe, the other global players, because some bit of the valuation is also driven by the flows which come from the FIIs. For them, obviously, India offers a much diversified opportunity. We actually have about 12 sectors to play. The largest sector has maybe a 30% contribution, and even that can be actually broken up into a 19% and a 20% and a 10%. And why I'm saying so is that for most of the other global players, actually there is a very high concentration of sector color in their indices. Which is not the case in India. We actually say, and this example I'm giving of Nifty 500, which has about 12 sectors. Most of the other indices in India also have those many sectors. It's just that the Nifty 500, because of the sheer breadth of the stocks, has actually a little more better color here. Coming to why this is important for any investor, because if we just look at PE in isolation, which is the 20x number here, you will feel that we are actually expensive, maybe relative to, except for United States, we are expensive to relative to all the other countries. But this has to be seen in conjunction with the earnings opportunity which India offers. So that's clearly you can see India versus the other global economies obviously is offering a much better earnings potential, and very much similarly reflective in the ROE also. So this was just to show you that when we are looking at a lot of parameters in our second principle, this is also one of the things that we look to see, because of the fact that there are other sorts of investments also coming into our markets, which might be looking at certain other parameters. And this is finally the third principle, just to maybe summarize the third principle, which was the sector cycle. Like I said, management quality is paramount for us, which could be the corporate governance, the quality of management in terms of their expertise in the businesses that they are managing, their track record of the management, and the track record, we look to even go a little next level to maybe, because obviously these days everybody does a very frequent call, so we can obviously track that, whatever they have been saying, and have been actually, is there a change in direction quickly or not? So just an example. And then are they really keeping the shareholders interest into mind or not? How is their capital allocation strategy, etc. So the second bit is the company fundamentals, which I had covered in saying that what are the return ratios, what are the which are the most important things actually with your ROEs and ROAs, what are there actually, the cash on the books, how are they really, whether the conversion of the earnings to cash, etc. So a lot of parameters which are important to understand the quality of earnings and not just the earnings. And finally, obviously, valuation is both an absolute and a relative call. Absolute, obviously, whether it's expensive or not, but has to be seen in the context of that. How is this sector placed versus maybe not just a stock versus other stocks in its own sector, but maybe a stock uh, with a parallel sector, and how are the valuations maybe panning out there. And I'll request your attention on this slide because it's a very important one. And here, the first thing which is a differentiation point in Bandhan business cycle is that we are actually calling out the strong deviations strategy that we are taking in the Bandhan Business Cycle Fund. So what is this deviation strategy? We are actually saying that there are actually, and the next slide is more of an illustrative approach. So we are saying that if at all there are these 12 sectors in Nifty 500, and the top 5 sectors, which are your banks, industrials, consumer discretionary, materials, IT, roughly are actually 60% of Nifty 500. We are saying that at any point in time of the fund's life cycle, we would be overweight in minimum of looking to take. We are even defining that. So we are saying that we look to be at a minimum of a 25% deviation from the current weight of the sector. Now, this deviation could be a positive deviation or it could be a negative deviation. Now, what I mean by this is that suppose any sector has, say, a 10% weightage in the index at the moment. If it all we are positive on the sector, the minimum weight we are going to take is about 1.5. And if at all we are not so positive on the sector, the minimum lower we are going to go 7.5. And because I'm stressing on the term minimum here, is because we could look to go even beyond 12.5, which is that 15, or we can look to go below 7.5, which could be but -2, because this is active sector strategy. So we are saying that that's how at Bandhan we are trying to be true to the label of the scheme, and we are trying to actually differentiate to create better alpha by having an active sector strategy call here, which we are defining by the example I just gave, that we would be active in minimum 3 of the top 5 sectors, and the deviation would be a minimum of 25% either up or down. Second is that this is actually a market cap agnostic strategy. Here, this is not a large or a mid or a small cap fund. It's actually the flexibility is to be across any market cap, because if you understood the this particular slide, like I said, it's actually a top-down strategy, and then we marry it with the bottom-up. So actually, the idea is that if at all, I could have put an equal to in terms of, instead of a portfolio creation, I could have maybe said the market cap is actually the outcome. So having understood the sector, having understood the stocks to put into the particular sector, and then finally the outcome is the market cap. So that's why I'm saying it's actually a market cap agnostic strategy. The idea market cap is not the starting point, but actually is the end result. So that's the flexibility which this strategy gives you. We would obviously, because we are promising that we are going to be active and we are going to actually take a strong sector strategy here, we would be actually be very dynamic in a sector allocation. And like I explained, the idea itself behind a business cycle investing is that the fund manager should ideally be rotating out of the sector wherein maybe the thesis has played out or the returns have been achieved, to into the next sector wherein the thesis is about to be played out, or maybe is yet to be and the valuations etc are there to maybe generate the next set of alpha. It's going to be a balanced approach. Like I said, there is a top down and there is a bottom up. And finally, from a risk management standpoint, because actually we have said that we are going to keep a maximum cash of 15% if at all need be. So this is not a given that we will be always be a 15% on our cash in our fund. But from a risk management standpoint, we have the flexibility under this fund to go up to 15%. And what are the reasons why we will really take these cash calls is obviously wherein we see that, the macros, or sorry, rather than even maybe the macro, or which in turn will impact the market. And that's where we think that actually it could be maybe a good strategy to at the moment to sit in cash. But just to reiterate, it's a flexibility and not that it is always be the case. So that's the why the Bandhan Business Cycle Fund, and the differentiation in terms of the strategy that I said, that we would always look to be active on minimum three of the top 5 sectors in Nifty 500. We will actually take a lot of active call even below 5 also, but that's not that's something which is expected out of us, because below 5 the sector weightages are actually very small. So that's why we are saying that we are actually promising on the top 5 sectors which form the majority, which is 60%. The bottom sectors are actually though 40%, but they are very maybe the average weights are about 6 to 7% to even some sector having a 1%. So in the top 5 sectors, which are the majority of the Nifty 500, that's where we are promising that we would be active in minimum 3 of the top 5 sectors, and we are defining that minimum deviation would be at least 25%. The next 2 slides are just to tell you that Bandhan as a house have we actually been right in our in our sector calls, and these are just 2 examples. We actually probably would have been right in more, but just to maybe show you 2 examples, and one is the auto sector here. So if you see these red bars, actually these are the overweight positions that we have kept versus the weight in the Nifty, say BSE 500 rather. So here what we are trying to say is that this blue line is actually the return of the BSE auto index over the BSE 500. So that is the alpha generation. So this, if you actually see, we brought overweight on the sector in the start. The alpha generation probably didn't really happen, but we kept on increasing our overweight because we were very positive on the story. We knew that the story would actually play out. Eventually, we even went to a very significantly higher on the or overweight stance from the inner starting point, and actually the alpha generation clearly is visible. So this was a strategy wherein, we studied the economic parameters. We understood where the market valuations are for the sector. Eventually, whether the sector's individual parameters, which are maybe, whether the auto volumes would improve or not, how is the raw material situation, etc. Having taken that call, we actually took this call of being overweight on the sector, and that's how the alpha generation happened. Secondly, capital goods, another example wherein actually, if you see, we actually pretty much played it throughout the life cycle of the, not the life cycle, I would say throughout a 5-year phase of the cycle. Here too, obviously, we kept on changing our weights because of the, maybe it could be the changing fundamentals of the sector, because this is a little more volatile sector. So from that perspective, again, the starting point is that where is the economy, whether the capex is actually looking up or not, where are we in the valuations, whether actually conviction is there on the sector or not. Finally, whether these companies in a capital goods segment are actually always rather in the recent history were always having a problem with the debt level debt on their books. So whether these companies have reduced the leverages and are actually lean enough to really take the next growth forward. And then basis that, the alpha generation, which is again, the BSE capital goods return minus the BSE 500. And that's where the alpha generation has happened. And we have pretty much been able to capture the same. So that's largely what I had for you. And maybe this particular slide and the last slide, 2 more slides actually. This obviously is a policy which we obviously follow across Bandhan, but it's an important one because there are a lot of external risks and internal risks which need to be monitored for the sector, for in the company and for the economy in general. So these are broadly the risks, and I would not spend too much time here. Finally, or rather not finally, maybe this is just to introduce you to Vishal and myself. So Vishal is the senior fund manager who will be managing the fund, Bandhan Business Cycle Fund. He already manages the Bandhan Infrastructure Fund and the Retirement Fund. Vishal has about 20 years of experience. And prior to taking over as a fund manager, in his initial days in his career, when he was a research analyst as well, so he's actually pretty much covered a lot of sectors, like as is listed here, in terms of utilities, materials, industrials, discretionary. As an analyst and obviously as a fund manager, he's seen all of it. I have about 14 years of experience, and I have seen the BFSI sector mostly over the last 14 years, and some bit on the consumption. So that's about the 2 managers who would be managing the business cycle fund. And maybe this, why you should consider investing in this fund, I have obviously tried to cover, and I hope I have been able to do so. But maybe this last slide is what I'll take some maybe 2 minutes of yours, and that would be the last bit from my end. So firstly, having just to maybe recap, we said that economy goes through various cycles. Every cycle throws an opportunity in terms of the sectors. So the idea is to be positive, or rather to be overweight in the sectors which are expected to do better to be underweight on the sectors which are not expected to do as well, because the sector performance will obviously have a bearing on the index performance and eventually the stocks which are there in the sector. So the idea of business cycle investing is to be a little more diversified. It's a diversified fund wherein you are taking a sector call, but you're not taking a one sector call, but maybe a 2 to 3 sector call. So then from there to this slide is to tell you as to why the business cycle fund of Bandhan is different. So like I had explained, it's a 360-degree approach. The number one point is that we are obviously looking to look at the economic cycle. Second is to understand the market cycle and eventually the sector cycle. It will be a agile sector rotation strategy. And I had explained as to the overweight stance that we are going to take in minimum 3 of the top 5 sectors in a Nifty 500. There could be 3 to 4 also, but we are saying that across the life cycle of the fund, we would look to be at the minimum 3 of the top 5. And here too, we have defined the minimum that we would look to take a active call of at least a minimum of 25% versus the benchmark, either up or down, basis our view on the sector. From a risk management standpoint, like I said, it's a market cap agnostic strategy. So the flexibility is there across the market cap. We have the opportunity to go up to a 15% cash if need be. And finally, like I said, that from a stock selection and from a, it's not just a top-down view. It's obviously a top-down come a bottom-up strategy. So that's from my end. And over to you, Disha.
Thank you, Ritika. Thank you so much on behalf of our entire team at GM Financial Services Limited. And definitely, it was one of the insightful presentation that we had from the Bandhan Business Cycle Fund, definitely. And your in-depth knowledge and clear explanation about the fund strategy and current market environment, one incredible value to our definitely all the audiences that we have on this platform. So we have few questions from our investors and I would like to bring it to the platform. Just a minute.
Sure.
I'm just putting it on screen. Yeah, is my screen visible? Yeah,
Yes.
So I'll just read out for everybody's betterment. So how does the fund manager identify different phases of the business cycle, expansion, peak, contraction, and trough? So I think this was the first slide of your presentation, whereas you have mentioned this, but if you would like to add on something, please go ahead.
Sure. So actually, I can actually just maybe show this also to maybe, make the discussion. So just let me know if this is visible.
Yeah.
Yeah.
It is.
So this is the slide actually. So we are saying that certain parameters, obviously, which are these green, bold highlighted, are tend to perform in a particular way in a particular phase. But before that, actually, this is our starting point to understand where are we in the cycle. So this is a very broad way of looking at it. How I had said that we are looking at firstly in a broad way, wherein we are saying whether the current GDP growth rate is above or below the long-term average. If it is above, then it is an expansionary zone. If it is below, it's in a contraction zone. Further, obviously, to maybe because we had defined 4 cycles or rather 4 phases, obviously, we in this pretty much in my this slide actually the expansion is somewhere is including peak also, and your contraction is including the slump. So these are I would say phases which we see as them in together, because actually it's always not so easy to pinpoint as to is this the peak or not, because there could be that because if you recall, I had said that every sector might have a little lead lag in terms of their performance fundamentally also, not just from a market perspective. So there could be a lead lag. So what could be the peak for the economy might not necessarily be the peak for the sector, but the sector might be in an expansionary zone. So I hope I'm making myself clear that we are actually seeing them a little on a broader way, that firstly, whether the economy is in a expansionary phase or not. And here we look at expansion and peak together, and we club contraction and slump together. And then this slide, obviously, which is helps us to maybe drill down a little more on a sectoral level, basis the parameters that I've shown, that whether the how is the credit growth, how is the capex, how is the interest rate, etc. So that's how we are looking to understand where are we, in which phase of the economy are we in, and the subsequent answer on sector selection.
Yes, thank you, Ritika, for the brief answer. So yes, moving to next question is, yeah. So the next question is the fund focused only on large cap stocks, or does it also include mid and small cap exposure depending on the cycle? So I think you have covered in one of your slides, but still,
Sure.
please throw
No,
some.
of course. So actually, I would just take you back to the same point wherein, we are saying that it's a market cap agnostic strategy. As a fund manager, we are not, the input into the fund is not to be a large, mid, or a small. The idea is that once we have understood the sector where we want to be overweight in, and understood the stocks within that sector where we want to be invested in, the eventual outcome is actually the market cap. So say example, suppose if we are very bullish on the banking sector, and the banking sector has about 19 to 20% weight in Nifty 500. And the color of the banking sector, and maybe if at all, suppose we would have been even positive on the IT sector, the color of the both sectors is that they are naturally a little on the large cap side. So because we are positive on the sector, and illustratively is what I'm saying this to you, we are positive on the sector, which is say banking and IT, and we have chosen say like, because of the weightage of the sector and the weightage of the top stocks are very high, naturally you would see the color of the fund looking more like a large cap. So it's more of an outcome rather than an input. So I hope I have been able to answer.
Yes, absolutely. Thank you for the brief answer. So yes, moving to next.
Okay.
How does the fund manage risk, especially during the period of economic downturns?
Great. So actually, again, I'll take you back to the first slide, and maybe, or rather, if at all this slide is still visible, I'm not sure. Yeah. So if you see in this particular slide, what I was explaining is that even the beauty of business cycle investing is that you can actually play across all the phases of the economy. Because what happens is that the idea behind business cycle is that you have to be doing a lot of significant sector rotation, because the winners and losers are not same in every economic phase. So if you recall, I had said that if you would see a very stark similarity in sense that the positive sectors in the expansion and a peak phase pretty much become the negative sectors in the contraction and slump phase, and vice versa, the negative sectors in a expansion and a peak phase pretty much become the positive sectors in a contraction and a slump phase. So the idea behind, again, to answer a question which is a valid question, that how would you actually manage economic downturns. So the idea is that even in an economic downturn, which we generally construe as a GDP growth faltering maybe versus the long-term average, there would still be certain sectors which, like I was highlighting here in this particular slide, there would still be a positive sector even in a contraction and a slump time. So the beauty of business cycle investing is that because of the active rotation strategy, you would look to basis the phase of the economy, look to rotate out of the sector which has already done well in the phase of the economy. And if the phase is changing, or even maybe we have reached the peak of the phase, but the phase is yet to change, we would ideally rotate out into the sector wherein the economy is looking to enter the next. So yeah.
Yes, thank you. Well clarified. Yes. So moving to next. Let me display it on screen. Just a minute.
I think I need to.
Yeah. No, it's done.
Okay.
Yeah. So what role does sector rotation play in the fund strategy, and how frequently is the portfolio adjusted?
See, ideally, cycles play out for a longer time. So it's very difficult to say that, you know, what is like, how frequently. Uh, my guess is that it should not be very frequent, because
Correct.
ideally, now it could be that, say, suppose we are positive on 2, 3 sectors today. And like I said, that every sector has its own cycle and their timing also could be different. Some could have a 2 year, some could have a 3 year. So suppose I can imagine a scenario wherein if we are in two sectors which are positive for us, maybe one might be at the late end of its performance, and one might we would have maybe entered in the mid of its performance. So this mid we would still look to play out till the time we achieve the full alpha. But the one where maybe we see that it is pretty much at the late end, we might look to rotate it out. So a difficult one to answer. I think ideally should be a little longer period, but will be different for different sectors. So a little difficult one to say that how frequently though, but ideally it should not be a very frequent adjustment.
Yes, correct, correct. So ideally, it should be long term only, not for the
Yes.
short run. Yes.
Yes.
So the next question is, can you please explain the impacts of macroeconomic indicators such as interest rate, inflation, GDP growth, etc., on the fund's performance?
Okay. So, see, again, I think this slide is coming out very handy here, which I think is still visible, right? Or I need to share again. I just share again.
You have to share.
Yeah, yeah. Just so, the question is that how does the various economic factors actually impact the fund's performance? See, our starting point, like I said, is that to actually first understand where are we in the cycle. And for understanding that, only we are actually using these parameters, which the question also states that how does the credit growth, how does the interest rate, etc., have a bearing on the fund's performance. If at all we have done our job well in terms of really understanding these economic parameters and how are the trends going to change here, whether the trend is going to continue to improve or falter, etc., basis that if we have been right in choosing the right phase and then finally choosing the right sector, ideally the fund should benefit only out of every economic parameter. Now here obviously there could be some lead lag, like I had started my discussion also. Certain trends are a little longer term, they take a little longer to change. Some trends are a little shorter, but stock performance maybe could maybe discount it a little advance. So maybe the fund's performance has to be also seen in that light, and also the sector rotation also has to be seen in that light. Maybe if in certain sectors their performance has actually happened much before that we anticipate in terms of the returns, but the story is yet to play out, it could be prudent to maybe still rotate out of the sector because the most of the alpha generation has happened, or maybe the story has played out much before we actually anticipated it to be. So that's how I would like to answer the question. So just to maybe say that we would be, the starting point of the fund itself is to see where the parameters are and accordingly choose the phase of the economy, and then finally make a sector call, which ideally should help us on the positive side.
Yes, thank you for the brief explanation. So moving to next, how does the fund manager balance between both defensive and aggressive sectors based on the business cycle?
So I would like to say that, uh, our strategy is not to be, obviously we would have to uh, be active in this rotation from defensive to aggressive or aggressive to defensive. But again, here the starting point, because if at all we are right in the I know I'm just repeating myself, but it is important that to understand that these things are our natural outcome. If at all a defensive sector were to really obviously do well, it would also corroborate with the phase that we have understood. And similarly, it will also corroborate with the phase that we have understood, wherein the aggressive also would look to do better. So again, it will be a play between defensive and aggressive, but the idea is not to just be between defensive, move from defensive to aggressive. The idea would be to first maybe understand again, just to repeating myself, that understand where are we in the phase, and accordingly this defensive aggressive would be an outcome.
Correct, correct. Yes. So next question is, what's the fund manager's outlook on the current business cycle and how is the portfolio positioned to capitalize on it?
Sure. So our current outlook is like I highlighted that on a very broad way, how we see actually is that the GDP growth rate expectation for this year and next year are actually above the long-term average growth rate. So by that, we are obviously in an expansionary phase still. Secondly, in terms of the portfolio positioning, and this is how we see on a model portfolio basis at the moment, we see we are actually positive still on consumer discretionary. We are positive on industrials. We are positive on financial services, sort of a neutral on banks as of today. And I'm breaking the BFSI sector into banks and financial services here. So these are our positive or the overweight sectors at the moment. The and IT also, my apologies, also makes into the fund on the positive side of our, and by positive always when I'm saying, I mean the sectors wherein we are going to take a very strong deviation. The sectors wherein, you know, our model suggests that we might not be as strong at the moment are your materials, energy, and materials, energy, and metals. So that is how the fund is currently looking at, and obviously, this is basis our understanding as of today. So that's where the fund is today. Is how I wanted to maybe answer the question.
Thank you, Ritika. That was the last question from our side, and you have beautifully answered all the questions. We truly appreciate the time and effort you took to share your expertise with us, and we look forward to the future collaboration as well. So, thank you once again for being a wonderful guest, and special thanks to you and your team, and also to our wonderful partners who have been a patient audience. So, yes, thank you so much once again to all of you. Thank you.
Yeah, thank you, Disha and Team JM Financial for hosting us. And thank you to everybody who patiently were actually hearing the presentation. I hope I have made good use of your time. So thank you so much.
Definitely, definitely. Thank you. Looking
Thank you.
forward for the future collaboration. Thank you.
Absolutely.
Thank you.
Thank you.
And thank you all the partners who have been such a patient listener for so long. And thank you. With this, we are concluding the session. Thank you.